What if I told you that a recession doesn't just rattle the economy, it could completely reshape what your money is worth? When recession flashes across the headlines, most of us feel a pang of fear. It's a word that conjures images of job losses, shrinking savings, and a future clouded with uncertainty. But what really happens to your money during a recession? Is it as catastrophic as we're led to believe, or is there a hidden side to the story? Today, we're diving deep into the mechanics of recessions and what they mean for your wallet, your savings, your investments, and your income. Let's start with a question that hits close to home. Have you ever wondered why recessions feel so personal? It's not just about stock markets crashing or businesses closing. It's about your bank account, your paycheck, your dreams. A recession is like a storm that sweeps through everyone's lives, but it doesn't hit everyone the same way. To understand why, we need to unpack what a recession is and how it wreaks havoc on your money. So, what exactly is a recession? At its core, it's when the economy shrinks, like the economy catching a bad flu. Technically, it's defined as 2 consecutive quarters of declining GDP, which is just a fancy way of saying the total value of goods and services produced drops. Businesses earn less, consumers spend less, and the whole system slows to a crawl. But that's the textbook definition. The real question is, how does this economic slowdown mess with your money? Let's break it down into 3 key areas: your savings, your investments, and your income. These are the battlegrounds where your financial life plays out during a recession, and each one tells a unique story of risk and opportunity. First, your savings. You might think money parked in a bank account is safe, right? It's not in the volatile stock market, so it's shielded from the chaos. Well, not quite. During a recession, the value of your savings can erode in ways you might not see coming. The biggest threat is inflation. Even in a recession, prices for essentials like groceries, gas, or rent don't always drop. In fact, they can rise due to supply chain disruptions, energy costs, or government stimulus programs. If inflation outpaces the interest your savings account earns, and most accounts pay less than 1%, your money loses purchasing power. That $1,000 you have today might only buy $950 worth of goods next year. There's another catch. Central banks like the Federal Reserve often slash interest rates during a recession to encourage borrowing and spending. That's great for borrowers, but it's a gut punch for savers. Lower rates mean your savings account earns even less, making it harder to keep up with inflation. And in rare severe cases, there's the risk of bank failures. During the 2008 financial crisis, banks like Lehman Brothers collapsed. And while FDIC insurance protects deposits up to $250,000, any delays or disruptions can feel like a nightmare when you're counting on that cash. The psychology of this is brutal. Seeing your savings lose value, even slightly, can spark panic. It's not just about the numbers, it's about the fear of losing your safety net. Behavioral economists call this loss aversion, where we feel losses twice as intensely as gains. That fear can push you to make rash decisions, like pulling your money out of the bank and stashing it under your mattress, which, let's be honest, isn't exactly a winning strategy. Now, let's move to your investments. If you've got money in the stock market, a recession can feel like a roller coaster with no brakes. Stock prices often plummet as companies report lower profits and investors flee in panic. During the 2008 recession, the S&P 500 dropped by nearly 50%, wiping out trillions in wealth. Retirement accounts like 401ks or IRAs tied to stocks can take a brutal hit, leaving you wondering if you'll ever retire comfortably. Mutual funds, ETFs, even high-flying tech stocks, nothing is immune when fear grips the market. But stocks aren't the only investments at risk. Real estate can also take a beating. Home values often drop, especially in overpriced markets, leaving homeowners with mortgages worth more than their properties. In the 2008 housing crash, millions of Americans found themselves underwater, owing more than their homes were worth. Even bonds, often seen as a safe haven, can lose value if interest rates shift unexpectedly, or if corporate bonds default during widespread business failures. Here's the flip side. Recessions can be a golden opportunity for those with cash and courage. When markets crash, assets like stocks or real estate go on sale. Billionaires like Warren Buffett have built fortunes buying undervalued companies during downturns. In 2008, Buffett invested $5 billion in Goldman Sachs at rock-bottom prices, reaping massive profits when the market recovered. In the 2020 COVID-19 recession, savvy investors snapped up tech stocks like Zoom and Nvidia at bargain prices, riding the recovery wave. And it's not just billionaires. Some middle-class investors who kept buying during the crash walked away with life-changing gains. The catch? You need liquidity and nerves of steel to buy when everyone else is selling in a frenzy. Let's dive into history to see how this plays out. The Great Depression of the 1930s saw unemployment hit 25%, with banks collapsing and savings wiped out. The 1987 Black Monday crash, while not a full recession, saw stocks drop 22% in a single day, shaking investor confidence. The early 2000s dot-com bust crushed tech stocks, with companies like Pets.com going from IPO darlings to bankrupt in months. The 2008 financial crisis, triggered by a housing bubble, crushed home values and retirement accounts. The 2020 recession, sparked by the COVID-19 pandemic, was shorter but brutal, with businesses shuttered overnight. Each recession has its own trigger: bubbles, pandemics, market panics. But the pattern is clear: economic slowdown, market fear, and unequal impacts. Now let's get to the big one: your income. For most people, a recession's scariest impact is the threat to their paycheck. When businesses struggle, they cut costs, and that often means layoffs. In the 2008 recession, the U.S. unemployment rate hit 10%, with over 8 million jobs lost. In 2020, unemployment spiked to 14.7% as restaurants, retail, and travel industries ground to a halt. Even if you keep your job, wage growth often stalls, and bonuses or raises vanish. If you're self-employed or run a small business, a recession can be catastrophic as customers tighten their belts and sales plummet. And it's not just about losing income, it's about what happens next. If you're forced to dip into savings or rack up credit card debt to cover bills, you're digging a financial hole that's hard to escape. High interest debt, often carrying rates of 20% or more, can spiral, especially if you're already stretched thin. For many, a recession isn't just a financial setback, it's a psychological one, fueling stress, anxiety, and fear about the future. So, why do recessions hit some people harder than others? It comes down to preparation and position. The wealthy often have diversified investments, cash reserves, and access to credit, letting them weather the storm or even profit from it. In 2020, the top 1% of earners saw their wealth grow by $1.5 trillion, while millions of workers faced unemployment. The average person, living paycheck to paycheck, has little cushion to absorb the blow. This inequality isn't just financial, it's societal, raising questions about fairness and opportunity. There's a psychological angle here too. Recessions don't just hurt your wallet, they mess with your mind. Fear of losing your job or savings can lead to panic decisions, like selling stocks at a loss or hoarding cash. The media amplifies this fear, with headlines screaming about market crashes and economic doom, pushing us toward irrational choices. Behavioral economists note that fear-driven decisions often worsen financial outcomes, trapping people in a cycle of loss. But here's the truth: recessions don't last forever. On average, they last about a year, and markets eventually recover. The S&P 500, despite its 2008 crash, hit new highs by 2013. Home prices, battered in the housing crisis, rebounded in most markets by the mid-2010s. The 2020 recession saw a sharp recovery in stocks by 2021, driven by tech and stimulus. The key is staying calm and strategic, which is easier said than done when your financial world feels like it's crumbling. So, what can you do to protect your money during a recession? First, build an emergency fund, ideally 6 to 12 months worth of expenses. This is your financial lifeboat. Second, diversify your investments and don't put all your eggs in one basket. Spread your money across stocks, bonds, real estate, and cash to reduce risk. Third, avoid high-interest debt like credit cards, which can spiral out of control if you're strapped for cash. If you're an investor, keep some cash on hand to seize opportunities. Recessions often create fire sales on stocks or properties, but you need liquidity to act. And if you're worried about your job, upskill or network now to make yourself indispensable. Side hustles like freelancing, online tutoring, or e-commerce can provide a buffer if your main income falters. During the 2020 recession, many turned to platforms like Etsy or Upwork to generate extra income, and many never looked back. On the tax front, recessions can offer small silver linings. If your investments lose value, you can sell them to harvest tax losses, offsetting gains elsewhere. If your income drops, you might qualify for tax credits or deductions you wouldn't normally get. These are small wins, but they add up when every dollar counts. Let's zoom out to the bigger picture. Recessions expose how fragile our financial systems can be, but they also reveal opportunities. The wealthy use downturns to buy low and build wealth, while others struggle to survive. Understanding what happens to your money, savings, investments, income, gives you a fighting chance to not just survive, but thrive. So the next time recession headlines start flooding your feed, don't panic, plan. And if this changed the way you see recessions, wait until you see how the rich use debt to get richer.